I'm Daniel Schwarzman, director of the Seeking Alpha Marketplace, and today I'm speaking with Michael Wiggins De Oliveira, who is the author of Deep Value Returns, a deep value service where the author has his skin in the game, investing in his top five stocks alongside his members. So, Michael, good morning. Welcome.
Thank you so much for having me, Daniel. I really appreciate it.
So, we're recording this on Friday, April 10th, and today we're going to talk about a couple streaming companies. We recently did a tech roundtable, and streaming is a growing sector of that. Streaming companies, but also bigger companies. Let's start with Disney, which is a company that you're interested in. You recently wrote as a cheap company. I actually did a podcast recently about Disney separately, and the thing that came up for us was it really is at the center of Corona headwinds. If you think about its different business lines, except of course for Disney Plus, which had great news after the close Wednesday, 50 million paying subscribers already. But why do you like Disney right now? Why is this on your radar?
Okay, a couple of things. I am so I don't have a position in Disney, but I'm a huge believer that investors are getting a strong bargain here. So the Disney is going through this year. It's going to be difficult for them. It's going to be very difficult for them this year. But investors are buying an asset, a business that has long trajectory ahead. The next thing I would say is that if you look back to approximately today, last year, when Disney had the analyst day, there was, okay, you know what, we're going to make a direct-to-consumer platform, and by 2024, we're going to have approximately 60 to 90 million paying subscribers. And everyone was like, what? Who's even going to pay for Disney? Who wants to watch like The Lion King? You know, people were like so doubtful. No one's going to pay for this stale library. And you fast forward 5 months and they're already like at 50 million, okay? So some people are saying that by June, they'll be at 70 million. So that means within a year, they basically said what they're going to do within 5 years. So there's clearly a very strong connection between what Disney Plus library. Next thing I would say, if you look at the valuation of Disney right this second, you're basically getting last year's price at a small discount before it said it was going to do all these things. So you already know that what they were going to do is actually happened. You already know that what they were going to say they're going to do in 5 years' time has already taken place. So yeah, you'll have to suffer through this year because, you know, the parks are closed and like a large portion of their programming, like sports programming, is that, you know, they still have to pay. So these are not non-cancelable contract obligations. You still have to pay that out. But then you already know that when next year comes around, you already have Disney Plus. Next thing I would say is that if you look at its balance sheet, so this is an argument people say, oh, you know, balance sheet is frail. There are few companies that are able to raise capital as easily as Disney. Disney is going to be able to raise capital with no problems. Interest rates are so low now that, you know, if I was in the credit side, I would just be willing to give them the money right away. The next thing I would say is that if you think about Disney's operating margins, so from about 2012 to about 2018, their operating margins were approximately 25%. From 2018 to presently, they have come down. The reason they came down was because they were aggressively investing in their Disney Plus platform. So they were basically having to reinvest for growth. So they were elevated expenses. But these elevated expenses are front-loaded. So you already know that it's paying off. Everything, you're getting already a huge return on invested capital from whatever they're doing. They're getting the subscribers through the door. So you take a little bit of pain right now as an investor, but in 12 months, everything comes back to normal and you straight away get a strong improvement in terms of operations. The other thing that this reminds me of is if you look at Buffett's investment in American Express in 1963 when there was the oil scandal. This is very much similar to that. I don't know if you know, but in 1963, there was the oil scandal, and there was the question mark of whether American Express should be liable to pay out this huge premium as an insurance for as part of that scandal. So they had to they basically that year, they're not able to pay out any dividends, and the stock tanked, and Buffett got involved, and he bought shares in company, and and things kind of came back out in like 18 months. So it's the same kind of movement here. So you're buying Disney, and you're like, let's say you're not getting your return as an investor this year. It's just basically a missed year. But that doesn't mean that next year things don't come back out. So despite investing a lot, Disney's free cash flow for last year was approximately 14 billion in terms of free cash flow. This is not earnings, but this is strong, tangible free cash flow. So let's say that in 2021, their free cash flow comes about, let's say, something in the ballpark of 16 billion. So you're kind of getting a company as Disney with a strong brand at approximately 10 to 12 times next year's free cash flow. So you just have to kind of buy right now, and then you just have to wait a little bit. And then you have to consider when next year comes around, people will say, okay, things are looking a bit more stable, and they will expand out that free cash flow multiple. So if you look at elsewhere, what you get comparable at less than 15 times free cash, they're not getting a lot of high quality businesses. Even now, after all this Corona thing came around, like you look at stuff like, I don't know, like even Alphabet or Microsoft, not getting things that cheaply. So yes, there has been a huge knock, but high quality businesses are not trading at 10 times free cash flow. So I believe that Disney is quite a strong business that you're able to get quite cheaply. Now, if you allow me to compare this with Netflix, so
let me jump in for a second before we get to a Netflix comparison, which is to ask about. So first of all, Disney Plus, the 60 to 90 million range is where I think they get to break even. So it's still probably costing money, and we still don't know churn dynamics, long-term production, which is obviously the same for Netflix, but production is on pause right now, etc. Well, they have animation, so animation is less on pause. But so Disney Plus is obviously the upside right now. But there is some risk here that, for example, box office was declining anyways as a general category, and now it's hard to imagine that once we get out of quarantine and lockdown and shelter in place, we're going to want to go sit in a movie theater because we've just been looking at our screens for months on end. And likewise, travel, it's not clear that it's going to bounce back to full in 2021. You may be an outlaw. And I guess the original thesis was Disney is going to be able to balance the trade-offs of switching to Disney Plus while still having all their cash-generating businesses. You're right that their balance sheet, they're not having trouble with liquidity. They've already priced a couple bonds during this period, so the liquidity's okay, but they do have quite a bit of debt, and so I don't have the free cash flow number in front of me, but your number isn't counting that they have, I think, over 60 billion in debt on the balance sheet too. So that's a factor here. So I guess given that there is I guess the more important question, because I guess the balance sheet stuff we kind of know where we will go, but do you worry about any long-term effects here, whether it be box office, which is important for Disney's marketing and hype machine, or whether it be that people are going to be, there's still going to be some lag before we get to normal in travel or anything else?
Okay, so with the box office, with the cinema specifically, two things. Number one, cinema isn't the biggest driver for Disney really up front. The second thing is that, you and I, we're not the core cinema type of people. You think if you're, let's say, an 18 to 25-year-old and you kind of want to get out of your parents' house to go on a date, you still want to do that, man. You look at everywhere on the news right now, even with coronavirus everywhere, people are just the youth is still congregating. So to say that in, let's say, a year's time, when everything is calmed down, that the youth will not want to go to the cinema, I mean, I don't buy that in 12 months, 15 months time, that people will not want to go to the cinema as much. But I say that in terms of the subscriber number to direct from the Disney Plus, what Disney Plus needs right now in terms of the share price is just investors to believe it has strong staying power, strong tailwinds to its business, because the market is forward looking. The market is always forward looking. So if you buy right now, everything is doom and gloom for Disney. But in 12 months' time, people are already looking out to 22, 23, and they're thinking, actually, you know what? This is like the business is back up. So I strongly believe that this is a lot of noise right now. People are just trying to time this in, people trying to be really smart. And I believe as an investor, the best thing to do is not try to be the smartest guy in the room. You look at how Buffett did with the banks in 2008. You look at that, he actually was nowhere near the bottom. You don't have to be as an investor. You don't have to buy the cheapest price. The game is to buy cheap and sell high. And you don't have to be the smartest guy trying to time it in. You just buy and you wait. And then you wait a year, you wait 2 years, and things happen and the world comes back to normal. And the thing that we saw in 2008 is that things come back to normal a lot quicker than we are actually led to believe. If you see, for example, the commentary from the likes of value investors like Seth Klarman, etc., in 2009, and they're just saying, listen, we buy and we just wait a little bit. And the thing is that things come back so much quicker. You've seen already, I'm not saying that as investors, we're already over the worst. I don't believe that from today onwards, the market will go up. There will be still some negative news coming out from coronavirus, and it's still going to, companies like Disney are still going to be affected. There's still going to be some sell-offs between now and the next 12 months. My sole contention is that in the case of Disney, from the valuation right now to what it's going to be in 12 months' time, because of it's just going to, I believe it's going to be high because people will be saying, okay, now parks are starting to slowly, partially reopen, and people just need a bit of optimism. And I believe that they will see actually things were not so bad because, for example, with the merchandise that Disney still sells, you can still get like my daughter, she wants the Frozen doll, you can still buy the merchandise. No one's stopping you from buying. So people are just very doom and gloom right now. But I believe that when those numbers come in, the quarterly reports come out in approximately a month's time, and then the next quarter comes out, people will start to say, actually, things were not as bad as we were led to believe. That's all I'm trying to say.
Okay.
Can I compare with Netflix?
Well, I think I'm worried that the Netflix angle, sure. I guess with Netflix, the question is, let me pose to you the two other things. Is Netflix, we kind of know the churn profile. We know that people stick around Netflix for a long time. And Netflix has more content, and its whole business is that, and so it's a predictable business. That would be the sort of bull for Netflix, and the bull for Disney, I imagine, is that you essentially going to create a new Netflix inside of Disney. Is that fair, or how are you thinking about it?
Absolutely. I even believe that the quality of Disney is far superior to the quality of Netflix. Like, you look at what kind of brand power does Netflix have? Netflix has a lot of rubbish, and Netflix didn't have to compete. Like, we'll see when the numbers come out in 2 weeks, but Disney was not on the scene strongly yet. It was only came in November, right? So you got a kind of you had a bit of a time for Netflix to kind of adjust, but the real first quarter now to compare, when you got that, you're going to question that predictability of Netflix when the competition actually comes up. You got Apple Plus, you got Disney. So these two tech giants were not there for Netflix in last quarter. So I believe that the quality we're going to see, whether the churn rate is really as stable as we were led to believe for Netflix. I believe that the quality of Disney's power, I believe, is much higher. I believe that the churn is going to be actually lower for Disney Plus than it is for Netflix. But, we'll have to wait and see until, the results come out now in April.
I should disclose, by the way, that I am long Disney. I haven't added anything in this sell-off, but I am long, and I think generally that long-term will be fine. Disney Plus, I'm waiting for, I'm in Spain. It just came out a week or two ago. I'm waiting for Mandalorian to finish, and then I'm not sure if I will. It basically has Mandalorian and The Simpsons, and I'm not sure if it has. But I also don't have children, so that obviously.
Okay, but
changes the
let me
game.
just say, the biggest problem I believe, in my humble opinion, for investors is that they look at themselves and they look at small anecdotal evidence and they extrapolate out. You don't have to like kind of try and figure out things from your perspective. You just have to look at the company, like how the company is reporting on a global scale. So just to touch, I mean, like the thing with Netflix, like aside from like a massageable earning power, that company, let's just say, okay, so Netflix, just roughly, Netflix makes about, let's say, 16 million or 16 billion of revenue. Let's say that it might make at some point in the future 10% of free cash flow. Let's say it might in 2025 make 1.5 billion of free cash flow. It might. Okay. Yeah, you could have the argument that that is very sticky and predictable, but we don't know, if it actually makes any free cash flow in our business, like strong free cash flow. But people are paying approximately 180 billion. So people are paying like more than 100 times hypothetical free cash flow for a business that is not going to be growing at 30% anymore. That business is not going to be growing at 30%. And you have to remember that the market that Netflix make a lot of revenue is from the US, but that's already saturated. That's, you've seen the numbers already. It's approximately 60 million US subscribers at the household. So you can have a bit of wiggle room with that number because you can put a password that you can lock out people. So more people have to in the US have to buy the Netflix the package, but it's largely saturating already the US number. The international number, there are some demographics, let's say in the UK, that that package is worth a lot, but internationally, Netflix is not worth the subscriber. International is not large, the RPU, the average revenue per user. So we don't know whether Netflix can actually make as strong a free cash flow as we're led to believe. So, and it's priced very similar to Disney. So if you look at, let's say, Disney, you're getting Disney Plus, which we have question marks whether it is as strong or not as Netflix, but you're also getting the parks and everything else with it. The cruises, everything, the merchandise. There's no merchandise of Netflix.
Like, right, but you're losing a ton of money in all of those other businesses for the foreseeable future.
Yeah, for 12 months. Yeah, you got that.
Potentially, and look, I think I hear where you're coming from. I guess there are two things. Well, three things. You also brought up your daughter's interest in frozen merchandise, so I think we've both.
Yeah, I don't actually buy her that.
Well, I'm just saying we're both extrapolating, or we're both bringing our anecdotes here. But the more important point is, I think the fact that Netflix's valuation is crazy, which I would agree with. I've never touched Netflix. I don't think that means you can say Disney's valuation should be like it's. I feel like investors often will compare this stock is crazy and this stock isn't, so this stock should be crazy. And I'm not sure.
I agree. Just because something is silly price doesn't mean that something else can be twice as silly.
Right.
Yeah, I fully agree with that. But
and then
we know. Yeah, sorry.
Well, I do think that investors shouldn't. Every time you make an investment, there's uncertainty, and obviously anybody who got in at Disney when it was down in the high 70s is feeling good right now. But the way I would put, again, I initially invested in Disney around 100, probably 2 years ago almost, and I would say that I would reframe what you said. 12 months ago, they announced Disney Plus, and the stock popped. And at that time, they had a very well humming parks business. They had a box office that was at peak box office, given all the Marvel movies and Star Wars, etc. They had a ESPN business they sort of stabilized its decline and is still a cash cow. They had merchandise in stores and etc. And so while you can still order online, you can't go to the store. And then they had this speculative Disney Plus and Hulu, which we haven't brought up. But Hulu is also an attractive part of their business. But 12 months later, Disney Plus is accelerating, but the parks, there's, is costing money, and there's a lot of doubt as to when that will come back to business normal. I think it will, but I would argue you're looking at maybe 18 to 24 months. That probably doesn't change the valuation. Box office, I think that there's a good chance we see a major. That was a business that was in decline already. I think this may accelerate that. And media networks, ESPN, if people are cutting the cord over, and we don't have the numbers yet, but if people are getting rid of cable because they just don't, you don't need ESPN when it's showing spitting contests or whatever it's showing, it all of a sudden really, I think Disney will be fine. I'm not interested in selling shares. I'm just saying that I think I do want to just kind of rephrase those as, if you invert it, you could say that Disney was in a stronger position a year ago than they were now, and so it's not a no. Your case is fair. I do think there's another side to that.
Okay, so let's say 18 months. Let's not say 12 months. Let's say 18 months. Parks are back to normal. So you're getting the parks, even if it just ticks along with inflation, which it has not, is shown over time, it doesn't tick, it does above inflation. But even if it just does inflation, you're in a stable business that is growing at approximately, let's say, 5% year over year, year over year, year over year. That's just making, so the studios is actually not that big a driver for Netflix as in terms of the revenue that it makes. The studios are not so big as the parks. The parks is what really brings in the tangible cash. Now, this is the thing, that the business model is pivoting. It's pivoting to an online platform. So they were very slow. I admit they were very slow and to recognize that potential, but they are pivoting towards that. So you get the terms of, you get the capital coming into the business, and it's doing really well in terms of it. Sorry, my daughter. It's get just a second. It's getting the capital in terms of the parks, so it doesn't have to go to the credit markets all the time. It doesn't have to really go, like in the case of Netflix, it doesn't have to raise that debt in capital markets at approximately 7% all the time. So so it has that kind of advantage over Netflix, that it doesn't need the debt. It doesn't need to. That's how the business model actually works. It works because the cash comes in from those sources.
We have a big Disney fan with us now, so let me ask you. Let's switch to a stock you do own, which is Discovery, DISCA.
Yes. Yeah.
What, you've been a long time bull. How do you feel it's positioned for this period of uncertainty?
I actually been bull for such a long time, and this has not so. This has been I've been bullish that company for more than 2 years. I've done a lot worse than you with discovering that one. And I don't. To be honest, I wish that I'd actually been a stronger bull at the beginning, because it was approximately $24 a share, approximately 18 billion market cap, and then it kind of went up a little bit, and now it's come down a lot. Now, here's the thing. So as of right now, because it doesn't matter what I paid 2 years ago, it only matters what's happening in the market right now. So in the case of Discovery, it's priced at approximately 11, 12 billion market cap. Okay. In 2019, it made 3 billion of free cash flow. So you're paying trailing, right? This trailing, you're paying approximately 4 times trailing free cash flow. It is Discovery is paid TV, so there is the element of cord cutting. So you gotta offset that. So you gotta think, okay, this is a cord cutting business. That's the headwind there. And you gotta see that the number of subscribers keeps going down. They don't really disclose how many households they own, but they do say, they do acknowledge that, as everyone knows, that cord cutting is taking place. So but they are being able to raise their prices. Now you got this year, like many businesses like Alphabet, like Twitter, like Pinterest, that advertising is falling. And advertising is part of their business model. So a portion of their business model is advertising. So they this year are struggling. But what they have been trying to do, they've been trying to grow the direct consumer business too. So they had said that by the end of 2020, before this whole Corona thing came up and the Olympics got cancelled or postponed, they were trying to grow the direct to consumer business at 40%. That's a very strong from starting from nothing. They were going to be able to be 1 billion of revenue by the end of this year, and we don't know. It might still happen. That nothing's stopping people from taking up the discovery platform. So they had said that 10% of its revenue by the end of this year, 1 billion, would be from their direct to consumer business. So 2 years ago there was nothing. They had nothing. And now in 2 years, 10% of the business is going to be from the direct-to-consumer platform. Now, I believe that at the end of this year, when they approximate 10% of its revenue from direct-to-consumer sources, they might segment that out. So once they segment out the growth of this direct-to-consumer platform, people will be saying, actually, this business is not as dead as we were previously believing. And their pay TV is very differentiated. It's totally differentiated. So they got stuff like Eurosports, which is obviously is not working now, but people like Eurosports in Europe. They got stuff like Animal Planet, that kind of home TV, cooking shows, home renovation. So this has a very strong demographic, predominantly females, 35 to 55 years old, which really resonate them. So they're like they hold the number 1 or 2 channels for females in the US at prime time, Sunday night, 6 to 9 p.m. So there is the argument that females will still be able to be compelled enough to log on and take on a package from Discovery as they migrate online more and more. So you'll get in a company at approximately 4 times free cash flow when things normalize again. So they made 3.1 billion of free cash flow last year. This is despite investing 600 million of cash into their direct-to-consumer business. So if things continue to stabilize, a coronavirus comes off and the Olympics are back on, people will want to watch, and they hold the rights to, it's the home of Olympics, is really Discovery or Eurosport. So if, let's say in 2021, the Olympics come back up, people will want to view the Olympics and they would go and view it through some channels such as Discovery. So the business gets a strong tailwind there. Their online business gets a strong push. So I believe that Discovery could really pick up a lot of momentum. And I know I've been wrong so far, but I believe that, at 4 times free cash flow, you're going to do okay here.
So I want to, I've looked at Discovery and I've been interested in it. And one of the things that scared me away, and I just pulled it up today, I think the market cap has actually popped back up to about 14, which is also about the amount of debt on the balance sheet. It's 14 to 15 billion in debt. So we have an enterprise value of double. And I guess, to me, the way I've approached this market, and probably too conservatively given the rebound we've had, is, will the company, does it have a clean balance sheet? Will it be fine if almost nothing good happens to it in the next 12 months? So how do you feel about Discovery? The fact that they have, it looks like mostly long-term debt, but still, how do you feel about the fact that they have meaningful interest? And I believe Discovery is part of the John Malone ecosystem, and he's a big debt guy. So how are you thinking about that as it's still an uncertain time?
Thank you so much for bringing that up. I should have said that straight away. So as an investor, as an equity shareholder, you're buying shares in the company. You're not acquiring the company, you're buying shares in the company, and the company is responsible for paying off the debt. That's the number one thing. So I know that people look at the enterprise value, but it's not a way that makes sense to Joe Greenblatt when he was doing his 50% returns from 1986 to 1999. So Joe Greenblatt is a big advocate of you buying shares in the company, and the company pays down the debt, number one.
To be fair, just to jump in on Joel Greenblatt, he did switch to the magic formula where EV to EBIT is the...
So just as a segue, on the Joe Greenblatt, so after he made a lot of money through the Gotham Capital, he said that I don't want to work as hard. I just want to make an index fund and to get institutional investors that will come in, and you can grow a very large asset management firm. Your returns are not as good for the green bond. You can see it in itself. You can look at the tracker for Gotham Capital, and you can see that it's marginally under, like just very closely track the S&P, and it's not really outperformed. It hasn't outperformed the S&P since its inception about 6 years ago. So you can say that that formula doesn't actually work as much as the 13 years that he was doing 50% a year. That's number one thing. So he was doing that, the 50. You have to look at what the investor was doing in its prime time. Let's say Buffett in the partnerships, or Greenblatt at his prime, and then you have to try and reconfigure that, not reconfigure what they're doing today when they're underperforming. So that strategy works, and I know it works. And so you're buying the shares of Discovery. It has net debt to EBITDA of approximately 3.1 times. So it looks like it's very leveraged on the balance sheet, but that's because they're making a large amount of EBITDA. So it is quite a predictable business in terms of how much churn rate you get in the case of Discovery, from how much cord cutting you get. You can easily predict that. So the cash flow, you can see the cash flow is organically still growing because they're increasing their package price. So you can very clearly see that they are still organically growing, ticking along. So their leverage is only 3 times. It's not a lot. Historically, they were leveraged 5 times. So 3 times is not a lot. The debt is long dated. So you're getting a business that has huge it's very sticky. It's a very competitive package, because the stuff that Discovery makes is not very expensive scripted content. They have by far the best margins compared to anything in this space, because they're basically coming up and they're filming someone making a cooking show. So it's not like there's no scripted content. You don't have to pay talent. You don't have to pay script writers. You don't have to pay studio time. You just go in someone's house, film making a paella. It's not like it's inexpensive, and then you charge people for it. And you can say, what about YouTube? YouTube does something very similar to that, and YouTube can be YouTube and Discovery have been together for more than 15 years. YouTube is not a new website, so I don't buy the competition from YouTube is going to kill off Discovery. That's not happening. So I believe that Discovery's business is much better competitively position than many people believe. I believe that its balance sheet is much stronger than it initially meets the eye. Just 3 times it's the leverage. It's not a lot. And as you said yourself, it's a John Malone company. He owns about 29% of the company, and he's recently made his biggest share price purchase in the open market. He put down $75 million at $30 a share. The share price yesterday was approximately $20 a share. So you can buy Discovery 30% cheaper than John Malone, that already owned 29% of the company, put down $75 million. So John Malone, if you look at his track record, he's very much actually even then slightly better than Buffett for all his conglomerates. He's still compounding his money at approximately 30%. So even if you say, okay, he's not the number one investor, he's still a pretty terrific investor, and he's a very astute businessman. And if he's putting down $75 million of his own money to basically buy shares in Discovery for $30 a share, I believe, you're paying 30% less than John Malone, I think things can work out. Also, you got to remember that you already know that the direct-to-consumer, Discovery's direct-to-consumer platform is growing at approximately 30 to 40%. And because they updated just recently, that the ratings for their ratings on their pay TV has soared. So even though the ad revenue has come down, as it come down for Alphabet, it's come down for Twitter, it's come down for Pinterest. So that at the moment the ad business, the ad sector has really come down, but people are coming back on to Discovery and watching. So the ratings are going through the roof. So you can say that there's going to be some stickiness as people come back onto Discovery. So I think that this could work out positively.
Okay. Very good stuff, Michael.
But as I said, I'm long Discovery. So This doesn't mean I'm right, and this we're just discussing. And I don't think that someone needs to go out and buy shares in Discovery. I'm just saying what I think, and I've been wrong before, and I can be wrong again. And I've been wrong so far for 2 years. So
Well, we all are at one time or another. So, any other disclosures beyond Discovery? Any other stocks that we discussed today that you have positioned?
no, just what we discussed today, just Discovery.
Okay. I have a position in Disney, also Alphabet, and a very small position in Pinterest. And I have looked at Discovery a little bit, and I may have to look at it again. It is an interesting story, and I think with a lot of these companies, it's the two big sources of uncertainty are how long and how deep does this go right now, and then what does the world look like after we get back to normal? How much is it the same? How much is it different? And so that's where the money's to be made right now for investors, figuring that out. So, okay, Michael, thank you so much for your time. Have a great rest of your day, a great holiday weekend, and best of luck to you in your investing going forward.
Thank you so much. Thank you.
You can check out Michael's work again on Seeking Alpha Marketplace. Look for Deep Value Returns or Michael Wiggins De Oliveira in any of our search bars, and you can check it out and get a 2-week free trial, I believe. So, okay.
Thank you so much. Thank you.
Thank you, Michael.